Hi, this video is going to walk through Vanguard's market risk and reward table. This table provides data going from 1926 through the end of 2022, and you'll see here it's data for the historical returns of just sitting on the sidelines in cash, the historical returns of being a lender in the bond market, and the historical returns of investing in U.S. stocks, 100% U.S. stocks. And then everything between the bond returns and the stock returns are 10% allocations, 10% increments of various combinations of stocks and bonds, from 10% stock, 90% bonds, to 90% stock, 10% bonds, and then everything in between. I'm going to minimize myself and put me up here. What you'll see here are the average annual returns between 1926 and 2022. If you just left your money on the sidelines in cash in a money market, or realistically down here, you can see the benchmark for cash or 3-month treasury bills, you'd have earned a 3.3% average annual return between 1926 and 2022. If you stepped off the sidelines and became a lender in the bond market, you'd have gotten a 5.07% average annual return. And if you said, well, I don't want to sit on the sidelines, I don't want to be a lender in the bond market, I'd rather own businesses, well, that would be a stock investor. And you can see that 100% investment in U.S. stocks over the last 97 years would have returned a 10.19% average annual return. Now, one thing that one headwind against all of these returns is the fact that things cost more that we're saving for, or if we're retired, the things we're spending our money on. So these are all headwinds against inflation. So you can look at this third column over here and you can see the inflation adjusted average annual return. So in other words, if you got a 5% return on paper and whatever it is you were saving for increased at a 5% annual pace between over the years for which you saved for that item, you really got a 0% return, a real return. And that's kind of what's happened if you just sat on the sidelines in cash. So cash provides daily certainty, but if you look, the average annual return, inflation adjusted over the last 97 years, was about 0.35%. I'd like to say put a plus in front of all of these numbers here, because you got a plus 0.35% return. If you're doing planning, we would encourage you to round down with any of these numbers. So you might call this a 0% return, or you might even give a -1 or a -2% average annual inflation adjusted average annual return if you sit on the sidelines in cash. If you enter the bond market, now you have to get some sort of return above and beyond cash, because if you got the same returns as doing nothing, any normal person or any sane person would say, well, why would I step off the sidelines and the daily certainty of sitting on the sidelines to be a lender if there's no investment return or extra return to do so? And you can see that being in the bond market over the last 97 years has given a plus 2.07% real or inflation adjusted average annual return. But again, you might want to round down and say, well, what if I get a plus 1% real return if you're doing planning? And because if you look, 17 of the last 97 calendar years actually saw losses in value of bond contracts. So there is risk and uncertainty. That's roughly once every 5 years you lose value. If you go to the stock market, that was a 10.19% average during the last 97 years, which includes the Great Depression, it includes the Great Recession, it includes all the bull markets, all the crashes. When the dust settles, you still got a 10.19% average annual return. But again, a portion of that is offset by the fact that things cost more over time. So relative to inflation, it's really been a plus 7.05% average annual return. And you can look here and see that 27 of the last 97 calendar years, you'd have lost value in the stock market. Sometimes those were pretty extreme. You can see the 1970s crash, the tech crash, the Great Recession, the 2008-2009 crash, you'd have lost 37% through the lowest month end of the 1973-74 crash. You'd have lost about 44% through the lowest month end of the tech crash. And in the 2008-2009 crash, through the end of March 2009, you'd have lost about 44% in investing in stocks. Now, the ensuing recovery since April 1st or March 31st of 2009 and through last year, through 2022, there was a 523.22% return in investing in stocks, basically. If you owned bonds during the 1973-74 stock market crash, you'd have lost about 5%. During the technology stock crash, bonds actually provided good ballast against stock market volatility. They were actually up about 29% during the period of time when stocks lost 44%. And in the 2008-2009 crash, when the stock market fell 44%, they actually were up about 5.36%, basically. But when you're doing financial planning, if you're going to sit on the sidelines with investments, and that means leaving your money in cash or money market type of investments or very short-term CDs, you want to assume that the cost of that safety or daily certainty is a return that simply moves in lockstep at best with whatever it is you're saving money for or spending money on if you are retired. If you're going to be in the bond market, you might want to assume a +1 or maybe a +2 if you have quite a bit of years until you need the funds. And you got to be really careful with the stock market, because even though over the last 97 years, U.S. stocks have averaged 7 relative to inflation, we've seen decades or 20-year periods like 2000 to 2020 where you got less than a 4% real return out of the S&P 500, for example. So you got to be careful with these numbers. And if you look at any combination of stocks and bonds here, so let's use like the popular 50-50 or 60-40 allocations, also known as moderate or balanced allocations, you can see that those averaged about 5.02 and 5.5 respectively over the last 97 years. But in planning, you might want to use something like a 3 or a 4% real return, and then and that's what you would want to do in actual financial planning terms. To put some math behind these, so let's just say you have $100,000 and you just put your money in a money market like investment or a savings account. I would assume a 0% real or inflation adjusted average annual return. So if first of all, if we look at this over here, the 3.3% return, on paper, if you got a 3.3% return, 100,000 would grow. You'd multiply times 1 to get the same 100,000, but you would multiply times 1.033 to get 3.3% more. And you hit enter, and that's 1 year of a 3.3% average. We could count to 10 just to see how this would play out if you got those kinds of returns over an entire decade. 2, 3, 4, 5, 6, 7, 8, 9, 10. So on paper, a $100,000 investment in a money market or a cash-like investment might turn into $138,358. But if whatever it is you were saving for also increased at a 3.3% average annual pace, then you got a 0% real return. You could simulate that by multiplying times 1.00, and it doesn't matter how many times I hit enter. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Your $100,000, even though it increased in value on paper, relative to whatever it is you were saving for or spending money on if you're retired, it didn't grow relative to those items you were spending money on or what you were saving for. That's the cost of daily certainty. That does not make leaving your money in cash a bad thing. If you have an emergency reserve, for example, or like sideline cash, you should want that to be extremely safe, because if you lose your job, which is a big reason why you might want to have an emergency reserve, it's not unlikely that the stock market will be down during a recession. That also is when you would have the most likely opportunity to lose your job, or the most likely at risk of losing your job. If you invested in the bond market, so we'll do that same 100,000, we'll multiply times 1.02, because we're looking at this right here. If you invested in the bond market for that same 100,000, we're going to assume that over a 10-year period you get a 2% inflation adjusted average annual return. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So now you got a situation where if you leave your money on the sidelines in cash, that 100,000 still buys 100,000. If you put it in the bond market and you get a 2% real return over a decade, it increases to just under $122,000 of purchasing power relative to what you're saving for. And if you put it in the stock market and you get that 1.07% return over an entire decade, not a guarantee by any means, but I'm just saying if you did get a 7% real average annual return over a decade, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, now your $100,000 almost doubled in purchasing power relative to whatever it is you were saving for. These are important numbers. And so you might say, well, if I leave money on the sidelines, I might at best get a 0% return. If I'm investing conservatively in the bond market, I might at best get a 2% average annual return above and beyond inflation. If I own stocks, I might get a 7 at best over the long haul. Now, granted, there are periods of time where you get significantly higher than 7% inflation adjusted average annual returns relative to inflation. If the stock market's up 40% one year and inflation is 3, that's a plus 37% return. If the stock market falls by 30% and we have inflation of 6, now you're down roughly 36% relative to inflation. So it takes time to see these play out. And if you're in a balanced allocation, so let's just assume a balanced allocation of stocks and bonds. So we'll just take a 50-50 allocation of stocks and bonds. And in planning, you might at best suggest or use a 4% real rate of return, even though it's a 5 on paper historically. But I'm going to use something more like a 4. We'll use that same 100,000 and we'll multiply times 1.04. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So here you just turned today's feel of $100,000 into today's feel 10 years later of $148,000, assuming you get a plus 4% real rate of return over a 10-year period. Again, these are just assumptions, but the math is exactly correct. You just got to be careful with how you use these. We use these in our planning analysis. So if you are getting this video, it's because we're probably doing planning for you or illustrating how real returns work, because they do come into play. So that's it. If you have any questions, you know where to find us. That's it. And we'll talk to you soon.